Amidst the economic downturn and pervasive gloom in China, the Chinese Communist Party's methods to sustain economic growth seem to have been reduced to fabricating data and silencing dissent. This involves maintaining an illusion of prosperity through falsified statistics, coupled with extreme control over public discourse to suppress any questioning voices. Commentators have ironically referred to these as the two magic weapons currently employed by the CCP echelons to combat economic recession. On December 11th to the 12th, the CCP Central Committee and the State Council held the Central Economic Work Conference in Beijing. This top-level economic meeting, held annually in mid-December, sets the agenda for economic development for the coming year, serving as a crucial window for observers to gauge China's economic policy. This year's conference brought forth an unprecedented proposition: the need to sing praises of China's bright economic future. It stressed the importance of, quote, properly interpreting statistical data to guide public expectations correctly. For the first time in decades, the Central Economic Work Conference explicitly demanded such firm control over propaganda and public opinion through media influence, viewing it as essential for revitalizing the economy and attempting to reverse the situation of declining trust and pessimistic expectations. Following the conference, the CCP's Ministry of State Security even threatened professionals, demanding they not speak negatively about China's economy, and instead resolutely sing its praises. This implies that no matter how severe the economic situation or how poor the data is, criticism of economic policies or painting a bleak economic future remains off limits, effectively silencing any dissenting voices. Recently, the CCP authorities released economic data for November, which superficially seemed better than expected, but was soon exposed by experts as severely and crudely fabricated. Let's examine the foreign trade data for November. On December 7th, the General Administration of Customs of China reported that in November, measured in US dollars, China's imports and exports totaled $515.5 billion, roughly on par with the same period last year. This included exports of $292 billion, up by 0.5%, and imports of $223.5 billion, down by 0.6%, with a trade surplus of $68.4 billion, a 4% increase. Chinese media widely celebrated these figures, heralding a stable and improving foreign trade situation. However, due to significant reductions in orders from Europe and America, many export factories have closed or moved out of China, leading to a continuous decline in China's exports. With a depressed foreign trade market and ports filled with empty containers, the transportation sector also faced dire challenges. November's trade data appeared to reverse the downward trend of the past 6 months, with exports even showing growth, seemingly indicating a bright economic future for China. However, the National Bureau of Statistics was soon criticized for data fabrication. Financial analyst Lao Man, renowned for his data analysis, published an article on Platform X, pointing out that China Customs' monthly data shouldn't be taken at face value, as it can be arbitrarily manipulated. Instead, he suggests using the cumulative data up to the current month, minus the previous month's cumulative data for accuracy. For instance, Customs audaciously announced November's export figures as $292 billion. However, the export figure for January to November was $307.74 billion, and for January to October was $279.2 billion. Thus, the actual export data for November is $28.54 billion. By the same calculation method, last November's export volume was $29.47 billion, not the $29.76 billion initially reported by Customs. Therefore, the real situation for November exports is a decline of 3.2% year over year, not the 0.5% growth reported by Customs. It's crucial to note that last November was the peak of nationwide stringent COVID-19 lockdowns in China. Economic activities such as transportation, logistics, infrastructure, and factory production were almost entirely halted. In early December, the CCP authorities abruptly switched policies, lifting controls without any preparation, leading to a massive outbreak of COVID-19 for 2 consecutive months. This means that from last November to this January, China's economic base was very low. Logically, surpassing these low benchmarks shouldn't have been difficult. Yet, this year's economy performed even worse, failing to match even the extreme conditions of the previous year. In response to the customs data, the overseas media outlet Epoch Times also analyzed and concluded that the data contained multiple errors. According to the data released on the customs website, from January to November 2023, China's total import and export value was 5.41 trillion, a 5.6% decrease from the same period last year. This includes a 5.2% decrease in exports and a 6% decrease in imports, with the trade surplus narrowing by 2.7% to 748 billion. However, upon inspection, the trade surplus for the same period in 2022 was reported as 802 billion, indicating an actual decrease of 6.7%. Errors were also found in customs calculations of the trade surplus rates with its 3 major trading partners, with all data being understated. The trade surplus with its largest trading partner, ASEAN, actually fell by 15.2%, contrary to customs' claim of a 1.7% decrease. With its second largest trading partner, the European Union, the trade surplus actually fell by 21.9%, as opposed to 16.7%. And with its third largest trading partner, the United States, the trade surplus actually fell by 17.6%, not the 11.6% reported by customs. In November this year, data from China's customs showed a trade surplus of $68.39 billion, a 4% increase year over year. According to the same source, the trade surplus for November 2022 was $69.84 billion. Thus, contrary to an expansion, this year's November trade surplus actually decreased by 2%. In October this year, the trade surplus, as per customs data, even saw a more significant year-over-year decrease of 30.8%. The primary reason for the decline in China's trade surplus in November is the significant drop in surpluses with its main trading partners. Data from China's customs indicate an 8.9% decrease in the trade surplus with ASEAN for November. Specifically, the trade surplus with Vietnam fell by 34.7%, with the Philippines by 32.6%, and with Singapore by 17.9%. China's trade surplus with the European Union decreased by 31.3% in November. Notably, Germany, which had a trade surplus, has turned into a deficit country this year, with the deficit rapidly increasing by 301% in November alone. Other countries with significant surplus decreases include France, down by 30%, Italy, down by 46%, and the Netherlands, down by almost 24%. Canada, which had a trade surplus with China last year, is now rapidly approaching a balance point. In the first 11 months of this year, China's trade surplus with Canada plummeted by 98%. China's trade deficit with Australia expanded by 35% year over year in November, and with Latin America, it widened by 623%, including a 52% increase in the deficit with Brazil. The deficit with South Africa expanded by 305%. Traditionally, November is China's peak month for exports due to the shopping season in Europe and America, stretching from Thanksgiving to Christmas. However, this year's situation is starkly different. Exports in November 2023 declined by 12% compared to the norm in 2021. This downturn is evident from previous reports that many export factories in China's major economic regions, like the Yangtze River Delta and the Pearl River Delta, stopped production in November, forcing many workers to return home 4 months early for the Lunar New Year. This is an unprecedented situation where the peak season is not bustling. Therefore, the data reveals an undeniable harsh reality. China's foreign trade in 2023 has significantly deteriorated compared to 2022, and continues to decline, severely shrinking its foreign exchange earnings. Last year, during China's stringent lockdowns, especially in major cities and ports, was an unusual period. The fact that this year's performance has not surpassed last year's indicates the severity of the current foreign trade situation. Industry insiders analyze that with the ongoing de-risking of supply chains in Europe and America, many Chinese export factories will either shut down or move out of China, leading to a continued decrease in exports to these regions. Consequently, the declining trend in China's trade surplus is expected to persist, with no possibility of recovery in the next 5 to 8 years. Zhang Jinglun, a Chinese-American financial commentator, noted that the continued significant decline in trade surplus will have a massive impact on the economy, potentially leading to reduced production and rising unemployment rates. China, being an export-oriented economy, relies on exports to drive related industries and improve employment. The country's severe unemployment rate this year, particularly among young people in some areas exceeding 50%, is somewhat connected to the falling trade surplus. Regarding data falsification by the CCP, Zhang views the miscalculation of trade surplus by the customs as laughable in an era of advanced calculators and software, confirming the long-standing criticism of data fabrication by the CCP. However, even with manipulation, the substantial decline in trade surplus is evident, showcasing the clear trend of developed countries decoupling from China. The poor foreign trade performance renders the CCP's falsification ineffective in covering up the situation. Besides the fabrication of foreign trade data, how reliable are the other economic statistics released by China's National Bureau of Statistics? According to the analysis by Lao Man, there are also falsifications in China's fixed asset investment data, which he describes as a blatant insult to the intelligence of the entire nation. Let's examine the fixed asset investment data released by the National Bureau of Statistics on December 15th. The total investment from January to November this year amounted to 46.08 trillion yuan, with the Bureau claiming a year-on-year growth of 2.9%. Based on these figures, last year's investment for the same period was 52 trillion yuan. A simple calculation reveals that this year's growth rate is actually a negative 11.4%. The critical private investment from January to November this year was 23.53 trillion yuan, with the Bureau audaciously claiming a decrease of only 0.5%, implying it was almost on par with last year. However, the actual situation is different. Last year's private investment for the same period was 28.41 trillion yuan, indicating a real decline of 17.2%. Focusing on November alone, the fixed asset investment was 4.14 trillion yuan, down 14.8% from 4.86 trillion yuan in the same month last year. The crucial private investment for November was 1.94 trillion, a 24.5% decrease from 2.57 trillion in the same month last year. Thus, the investment in November not only continued to fall, but also showed an intensifying decline compared to the same period last year. Considering the national lockdowns last November, this highlights the severity of China's economic situation this year. Lao Man laments that this situation is pushing the populace to a state of despair, evident in the 25% year-on-year decrease in private investments for November. Interestingly, in its recent economic data release, the National Bureau of Statistics did not disclose the closely watched unemployment rate among the 16 to 24 age group, stating that they are waiting for the completion of statistical work. The last reported figure in July for June's youth unemployment rate was a record 21.3%, and no further updates have been provided since. Even this data has been questioned. Independent calculations by Chinese economists suggest the actual figure might be as high as 40%. Additionally, on December 9th, the Bureau released two other significant economic indicators. November's Consumer Price Index (CPI) decreased by 0.5% year-on-year, the largest drop in 3 years. And the producer price index PPI fell by 3% year-on-year, indicating an economic downturn and intensifying deflation. The continuous weakness in China's economy is evident from the stream of negative economic data. The day after the Central Economic Work Conference on December 13th, the party group of the National Bureau of Statistics held an expanded meeting to convey the messaging of the conference. The meeting emphasized the need to, quote, properly interpret statistical data to guide public expectations correctly, meaning to alter the public's pessimistic and disappointed mood. In this context, netizens noticed that a number of financial analysts' social media accounts have been silenced. Chinese economic analysts have been jokingly referred to as risk masters. Experts in joint stock systems and corporate issues such as Liu Jipeng, Hong Rong, and Shui Pi, among other economic commentators, faced a complete online ban. This ban has not escaped public attention. Several Chinese financial bloggers told AFP that they received warnings from Weibo to be careful with their words in upcoming posts and avoid any remarks that could be seen as talking down the economy. One Chinese economist with over 9 million followers said that despite his optimistic stance on China's economic prospects, he too received similar reminders recently. Tech blogger Juecang Shiduwa commented, "How would we view the recent silencing of financial bloggers? If only one voice is allowed in this world, then that only existing voice will be a lie." Liu Jipeng, who was silenced on December 7th, is the dean of the Capital Finance Research Institute at China University of Political Science and Law, and the chief expert of a major National Social Science Fund project. He has served as a member of drafting groups for numerous securities-related laws of the National People's Congress, independent director of several well-known listed companies, and led the stock reform, corporate strategy, mergers and acquisitions, and investment plan design for over 270 companies. As an expert in China's capital market, Liu Jipeng often expresses his views on the A-share market and policies through media interviews and social accounts. He openly states that China's capital market is marked by unfair wealth distribution and a lack of justice since the reform and opening up in the 80s and 90s. The main issue, he points out, is that major shareholders are not focusing on operations to achieve multi-win situations for all shareholders of listed companies. Instead, their focus is on reducing their stakes in these companies. This is able to happen because of the dominance of a single large shareholder. On December 5th, Liu Jipeng publicly urged the government to prioritize revitalizing the stock market and to pay significant attention to the financial sector while improving its capabilities. These remarks by Liu drew the attention of the authorities, and subsequently, on December 7th, multiple social media accounts of his, including Douyin, Weibo, and Toutiao, were muted and prohibited from gaining new followers. His Weibo account has been deleted. The official reason for this silencing remains undisclosed. Commentator Li Ang, in an interview with Radio Free Asia, stated that the authorities are not only punishing dissident in the economic field, but also in other areas that contradict the government's stance. He said, "I read an article saying that economists have been silenced. Any speech that does not align with the authorities' demands, especially those that are pessimistic about the Chinese economy, are being prohibited. This is not just targeting the economic community. It affects everyone, including us." In response, Liu Shuqing, a legal professional focusing on the Chinese economy, said, "The prohibition is against negative views, emphasizing the need to promote China's economy, which is indeed linked to confidence. The lack of confidence among the people stems from their doubts about their property, freedom, and security. This uncertainty deters them from entrepreneurship." Liu Shuqing points out that the current state of the Chinese economy is less favorable than before. For improvement, reforms are essential. He says, to restore public confidence, the government should first undertake fundamental reforms aimed at expanding the freedoms and rights of its citizens. Economic development cannot be achieved through propaganda. The situation of imports and exports, the employment rate, and consumer behavior all depend on the economic environment. While the National Bureau of Statistics can present favorable numbers, it cannot alter the reality of the ailing economy. In the second half of this year, various departments in China introduced over 100 measures to salvage the private economy, yet they have been unable to change the current situation. Netizens comment that with foreign capital withdrawal, real estate company defaults, and mounting local government debt, China can no longer return to its era of prosperity. Another netizen remarked, instead of being the leader among the poor, why not humble ourselves and sincerely befriend the United States? Perhaps in less than 3 years, a glorious era might unfold.